They passed it. The new banking rule goes live tonight, 5s or p.m. The doors closed, the weekend began, and a rule quietly took effect that changes everything. By Monday morning, access to your own money may no longer work the way you expect. Friday wasn't chosen by accident, it never is. A $500 withdrawal ceiling, delays to access your own funds, attempts to move money into gold, crypto, or silver now flagged, reviewed, frozen. This isn't speculation, this is written into the rules. We've seen this sequence before. Greece, Cyprus, Lebanon, different countries, same pattern. The question isn't whether this affects you, the question is how much time is left before you feel it. Now, before we go any further, there's something you should understand. Information like this doesn't come from headlines or evening news. It comes from buried documents, regulatory language, and decisions released late on a Friday when no one is paying attention. If you've lived through a few economic cycles, you already know how this works. The people who see it early aren't smarter. They're just paying attention. So if you want to stay ahead of what's unfolding, make sure you're subscribed. Not out of habit, but because what we're about to walk through could be the difference between having options and having none. And let me know in the comments where you're watching from. The United States, Europe, somewhere else. Because this isn't a local story anymore, it's global. Now let's talk about what changed at 5 p.m. and what that means for your money before Monday morning. Financial regulators have a playbook, and Friday evening is page 1. Release controversial policy changes after the markets close when newsrooms are winding down. When most people are thinking about their weekend plans, not their bank accounts. By the time Monday morning arrives, the rule is already law, no debate, no public comment period, no warning, just implementation. This particular rule does something very specific. It imposes strict daily limits on cash withdrawals starting immediately. Anyone trying to pull more than $500 from an ATM will likely see a declined transaction. Not because their account is empty, not because of insufficient funds, but because the system now has a ceiling, a hard limit on how much of your own money you can touch in a single day. If someone walks into a bank on Monday morning and asks for $5,000, they won't walk out with cash. Instead, they'll be handed a form, a request form, one that requires approval, and a 7-day waiting period. 7 days to access money that sits in an account with their name on it. The banking system has effectively created a rationing mechanism for cash. But why? The official explanation speaks of stability, of preventing panic, of protecting the integrity of the financial system. The mathematical reality tells a different story. Banks operate on something called fractional reserve banking. This means they don't actually keep all depositor money in their vaults. They keep a fraction, typically around 10%, and loan out the rest. This works fine until people start asking for their money back simultaneously. When withdrawal requests exceed available reserves, the system breaks. And right now, beneath the surface of official statements and reassuring press releases, banking sector balance sheets are showing stress. Not the kind of stress that makes headlines, but the kind that shows up in quarterly filings, in derivative exposure reports, in the quiet conversations happening at Federal Reserve meetings. The institutions know something the public doesn't yet. They know the reserves are thin. They know the loan portfolios are deteriorating. They know that if enough people tried to withdraw cash at once, the entire system would seize. So, they've done what governments always do when the math stops working. They've changed the rules. History provides a clear pattern here. Before every major banking crisis, before every currency collapse, before every systemic failure, there's a moment when access to money becomes restricted. It starts small, a limit here, a delay there, a form to fill out, and then gradually or suddenly the restrictions tighten. What begins as a $500 ATM limit becomes a total freeze. What starts as a 7-day approval process becomes indefinite suspension. The people who study financial crisis have a term for this. They call it the denial phase. It's the period where officials insist everything is fine while simultaneously implementing emergency measures. The contradiction doesn't matter because by the time the public notices the contradiction, the restrictions are already in place. This new rule does something else that most people won't catch on first reading. It expands the definition of suspicious activity. Under previous regulations, banks flagged transactions that appeared to involve money laundering or criminal enterprises. Under this new framework, the definition broadens considerably. Now, if someone tries to move money into cryptocurrency, that's potentially suspicious. If they purchase physical gold or silver, that's flagged. If they make any transaction that suggests they're trying to exit the traditional banking system, the institution is legally required to report it. And once flagged, the account can be frozen for up to 30 days while investigators review the activity. 30 days without access to funds, not because of criminal wrongdoing, but because someone tried to buy an alternative asset. This isn't about security. This is about building a fence around the exits. The banking system is creating a perimeter, a digital wall that makes it increasingly difficult to move wealth outside their control, and they're doing it quietly. On a Friday evening while everyone else is thinking about the weekend, the question every depositor should be asking is simple. Why now? What do the regulators know that they're not saying? And more importantly, how much time is left before the restrictions get tighter? 3 countries, same week, identical playbook. While Americans were learning about their new $500 withdrawal limit, banking regulators in the United Kingdom quietly rolled out similar restrictions. Australia followed 48 hours later. Same language, same structure, same Friday evening timing. This wasn't coincidence, this was coordination. When financial systems move in lockstep across continents, it signals something larger than domestic policy adjustment. It signals preparation. The question is, preparation for what? Buried inside the new banking rule is a section most people will never read. Section 4.7, subsection B, paragraph 12. It redefines as what constitutes high-risk financial behavior. Under the old framework, high-risk meant dealing with sanctioned nations or moving large sums without documentation. Under the new framework, high-risk includes something far more ordinary: purchasing cryptocurrency, buying physical precious metals, transferring funds to non-traditional financial platforms. Any transaction that suggests a depositor is seeking alternatives to the conventional banking system now triggers an automatic review, not a manual review where a human being examines the context. An algorithmic flag that freezes the account first and asks questions later. The freeze can last 30 days. 30 days where bills still come due, where rent still needs paying, where life continues, but access to money stops. And here's what makes this particularly revealing. The rule doesn't require proof of illegal activity. It doesn't require suspicious patterns. It only requires movement toward assets the banking system doesn't control. This is capital control disguised as consumer protection. Economists have studied capital controls for decades, usually in the context of emerging markets or failing states. Argentina implemented them during its currency crisis. Venezuela used them as the bolivar collapsed. Greece deployed them when the Eurozone debt crisis threatened to trigger bank runs. The pattern is always the same. First, they limit how much money can leave the country. Then they limit how much money can leave the banking system. Then they limit how much money can move between accounts. Each restriction is presented as temporary, as necessary, as protective. But temporary measures have a way of becoming permanent when the underlying crisis never resolves. So why are developed nations, stable democracies with reserve currencies, suddenly implementing tools previously reserved for economic emergencies? The answer lies in what's coming next. Central bank digital currencies. CBDCs represent the final evolution of monetary control. Unlike physical cash, which can be held privately and spent anonymously, digital currencies live on a ledger that records every transaction: who bought what, when, where, and from whom. Every purchase becomes a data point. Every transfer becomes trackable. Every financial decision becomes visible to the institutions that manage the system. But here's the challenge for central banks. As long as physical cash remains convenient and accessible, people will use it. As long as ATMs dispense bills without restriction, people will withdraw cash. As long as alternative stores of value remain easy to purchase, people will diversify. The only way to make digital currency inevitable is to make everything else inconvenient. This is where the new banking rule becomes a bridge. By restricting cash access, they create friction. By flagging alternative asset purchases, they create fear. By making traditional banking difficult, they make digital alternatives appealing. Instant transfers, no withdrawal limits, just scan your face and go. That's the pitch that's coming. And it will sound reasonable because they've spent months making the alternative unreasonable. This isn't speculation. The Bank for International Settlements, the central bank for central banks, published a paper 18 months ago outlining this exact strategy. They called it making cash costly. The theory is simple. If you make physical currency expensive to use, people will voluntarily adopt digital alternatives. How do you make cash costly? Withdrawal limits, processing delays, suspicious activity flags, branch closures, reduced ATM networks, death by 1,000 inconveniences. Meanwhile, behind the scenes, the infrastructure for programmable money is being built. Programmable money means currency that comes with rules. Imagine a dollar that can only be spent at certain stores, or a dollar that expires if not used within 30 days, or a dollar that cannot be used to purchase certain goods or services. This isn't science fiction. China's digital yuan already has these capabilities. Sweden's Arona is testing similar features. The European Central Bank's digital euro project includes targeted spending functionality. And now the United States banking system is creating the conditions that make such a system not just possible but necessary. Because once cash becomes inaccessible, once alternative assets become flagged, once the traditional banking system becomes a maze of restrictions and delays, people will beg for the solution, they'll beg for convenience, they'll trade privacy for efficiency, they'll accept programmable money because anything is better than standing in line for 7 days to access $5,000 of their own savings. But there's another layer to this. Small businesses run on cash flow. Not cash in the literal sense, but the ability to move money quickly. A restaurant needs to pay suppliers often daily. A construction company needs to cover payroll. Every week. A retail shop needs to restock inventory constantly. These businesses operate on thin margins where timing matters. A 7-day delay isn't an inconvenience, it's a death sentence. The new rule doesn't affect large corporations the same way. They don't deal in cash. They move money through corporate accounts, lines of credit, payment systems that bypass consumer banking restrictions. This creates a two-tier economy where big institutions operate freely while small businesses suffocate, where Wall Street maintains liquidity while Main Street fights for access. The consolidation isn't accidental, it's architectural, and it's happening right now while people are still trying to understand why their ATM has a new limit. The fence is going up, the exits are being monitored, and the question every person needs to ask is whether they're inside or outside when the gate finally locks. There's a photograph that economists pass around in quiet conversations. It shows a line of people stretching 3 city blocks outside a bank in Athens. The date is June 28, 2015. The people are trying to withdraw $60, not $6,000, not $660. That's all the ATM would allow. The Greek government had announced the restriction at midnight on a Sunday. By Monday morning, the entire nation was rationing money. What most people don't know is what happened 3 weeks before that photograph was taken. On June 5, 2015, the Greek Finance Ministry issued a statement. All deposits are completely safe. There will be no capital controls. These rumors are irresponsible. 3 weeks later, the ATMs had limits. 4 weeks later, the banks closed entirely. This is the pattern: denial, then restriction, then freeze. And it never happens in reverse. The financial historians who study these events have documented this sequence across decades, across continents, across different political systems. The specifics change, but the structure remains identical. Cyprus, March 2013. The government spent 2 weeks assuring depositors their money was protected. Then on a Saturday morning, they announced a bail-in. Large depositors would lose 47% of their savings to recapitalize the banks, not through taxation, not through legislation, through direct confiscation from accounts. The people who tried to withdraw money the week before, and when the rumor started, found their transactions flagged and delayed. By the time the announcement came, it was too late. Lebanon, October 2019, the central bank governor appeared on television. The Lebanese pound is stable. Our banking system is sound. Foreign currency reserves are adequate. 2 weeks later, unofficial capital controls appeared. Banks started limiting dollar withdrawals, first to 1,000 per week, then to 500, then to nothing. The official exchange rate said one thing, the street exchange rate said another. People with millions in their accounts couldn't access enough to buy groceries. 4 years later, those restrictions are still in place. The temporary emergency measures became permanent reality. Argentina provides an even longer case study. December 2001, the Corollo. The government froze all bank accounts, limiting withdrawals to 250 pesos per week. People who had saved their entire lives in dollars suddenly couldn't touch them. The freeze was supposed to last 60 days. It lasted years. When accounts finally reopened, the government had converted dollar deposits to pesos at a rigged exchange rate. Savings that had taken decades to build evaporated in a policy announcement. The pattern appears across different eras, different currencies, different political ideologies. Where Germany, Zimbabwe, Venezuela, Turkey. The sequence never changes. First comes the assurance that everything is stable. Then comes the small restriction presented as temporary and protective. Then comes the larger restriction justified by external crisis. Then comes the freeze blamed on emergency circumstances. Then comes the confiscation renamed as restructuring or contribution to stability. By the time the public realizes what's happening, the exits are already sealed. So when 3 major Western democracies implement withdrawal restrictions in the same week, when the United States, the United Kingdom, and Australia suddenly coordinate capital control measures, when this happens, not in response to a visible crisis but preemptively, the informed observer doesn't ask if something is coming. They ask how much time is left, because the pattern that never lies is now playing out in real time. And the pattern says restrictions don't appear unless the system is already broken. They just haven't announced it's broken yet. There's another element to this pattern that deserves attention. The weekend financial crises have a calendar preference. They happen when markets are closed, when people can't react, when the information gap creates maximum advantage for institutions. Beer Stearns collapsed on a Sunday in March 2008. Lehman Brothers filed for bankruptcy on a Sunday in September 2008. Greece announced capital controls on a Sunday in June 2015. Cyprus announced the bail-in on a Saturday in March 2013. The weekend provides a 48-hour buffer where money is trapped, where people can't move assets, can't withdraw funds, can't protect themselves. By Monday morning, when markets reopen, the landscape has already shifted. This new banking rule activated on a Friday evening gives institutions an entire weekend of restricted access. If something happens Sunday night, if a major bank fails, if a derivative position unwinds, the depositors are locked in. They can't pull money out. They can't transfer to safer institutions. They can't react at all. They just become unsecured creditors in whatever comes next. The regulatory language even contains a provision for this. Section 7, Emergency Powers. It states that the Federal Reserve can suspend all withdrawals if deemed necessary necessary for national security or systemic stability, not through congressional approval, not through public vote. They can be held without institutional custody. The banking system's response to cryptocurrency has been telling. First, they ignored it, then they mocked it, then they tried to regulate it. Now they're flagging anyone who tries to buy it. That progression reveals fear. Not fear of the technology, fear of the alternative it represents, because every dollar that moves into crypto is a dollar that leaves their balance sheet. Every person who holds wealth in decentralized assets is a person who doesn't need a bank. The new rule doesn't ban cryptocurrency purchases, it just makes them suspicious, flagged, subject to 30-day holds. It creates friction, it creates fear, it creates exactly enough barrier to discourage most people while maintaining the illusion of freedom. But friction works both ways. It slows the exit, but it also proves the exit matters. Beyond assets, there's the question of community. When banking systems restrict, when digital surveillance expands, when individual transactions become monitored, the informal economy grows, barter networks emerge, direct exchange relationships develop. People who produce food, trade with people who provide services, people with skills, exchange with people who have goods. This isn't a return to primitive economics. This is a parallel system that operates outside digital surveillance. Cash transactions, direct trades, community relationships. These become more valuable as the official system becomes more restrictive. Building those relationships now before the crisis creates resilience. Knowing local farmers, local builders, local service providers, these connections matter when the system fails because the system will eventually require something that many people won't accept. Digital identity tied to financial access. The infrastructure is already being built. Biometric verification for ATM withdrawals, facial recognition for mobile banking, digital ID requirements for account access. It's being rolled out as security, as convenience, as protection against fraud, but the real function is control. Because once financial access requires digital identity, identity becomes the lever of compliance. Criticize the wrong policy, lose banking access, engage in the wrong transactions, lose financial rights, associate with the wrong people, lose economic participation. This isn't theoretical. Canada demonstrated it in 2022 during the trucker protests. Bank accounts frozen without trial, without conviction, based purely on political association. The infrastructure exists. The precedent is set. The new banking rule expands that infrastructure domestically. So the final question becomes philosophical. What is wealth? Is it numbers on a screen that can be frozen with a keystroke? Is it access to a system that requires permission to use? Or is it something held, controlled, owned, independent of institutional approval? The people who survive systemic transitions are the ones who answer that question before the crisis, not during it. They're the ones who diversify across systems, not just across assets. They're the ones who build redundancy, who create options, who don't depend on a single point of failure. They're the ones who understand that true wealth is what you can access when permission is denied. Right now, today, this Friday evening, when the rule goes live, there's still time. Time to move funds to less exposed institutions. Time to establish cash reserves for operational continuity. Time to acquire physical assets outside the banking system. Time to build community relationships that don't require digital intermediaries. Time to create options before options disappear. But that time is measured in days, not months, because the pattern is clear. Restriction leads to freeze. Freeze leads to confiscation. Confiscation clears throat, gets renamed as contribution, and by the time it's announced on the evening news, the exits are already sealed. The informed act while others debate the prepared position, while others wait for clarity. The independent move while others seek permission. Because in every historical collapse, in every currency crisis, in every banking system failure, the same truth emerges. Wealth inside the system is permission. Wealth outside the system is ownership. And the difference between the two is measured in the freedom to act when action matters most. The rule is live. The restrictions are active. The weekend has arrived. Monday morning will reveal who prepared and who waited too long. The choice for now remains individual, but the window is closing through executive decision by unelected banking officials. One switch and the ATM network goes dark. One announcement and every account freezes. The infrastructure for total lockdown is now legally in place. Today it's a $500 limit. Tomorrow it could be zero. And there's a mathematical reason this is happening now. The derivative market, global derivative exposure, currently sits around $1 quadrillion. That's not a typo. Quadrillion with a Q. These are bets built on bets. Leveraged instruments that create artificial value until something breaks. And when one major position fails, it triggers a cascade. Counterparty defaults lead to margin calls. Margin calls lead to forced selling. Forced selling leads to price collapse. Price collapse leads to more defaults. The entire structure is interconnected. If one major bank goes down over a weekend, the contagion spreads before markets can even open. The withdrawal restrictions aren't about protecting depositors. They're about making sure depositors can't escape before the implosion. Meanwhile, while implementing these restrictions on the public, central banks are buying gold at record rates. The People's Bank of China added over 200 tons in the last 18 months. Russia continues accumulating despite sanctions. Even the Federal Reserve's balance sheet shows increased gold holdings. The institutions preparing the digital currency future are simultaneously hedging with the oldest form of money in human history. That's not a contradiction. That's clear as throat a confession. They know what happens when debt-based systems collapse. They know what survives when confidence evaporates. They know that gold doesn't require counterparty trust, doesn't require banking infrastructure, doesn't require regulatory permission. So they accumulate it while telling the public to trust the digital system, while restricting access to physical alternatives, while building the fence around the exits. The pattern is complete. The denial phase is ending. The restriction phase has begun, and anyone who studied the historical sequence knows exactly what comes next. The only question is timing, and the only advantage is preparation, because once the freeze is announced, the pattern says it's already too